What's up, guys? Welcome to another episode of Invest with Obi. Today, I have the pleasure of having Sheri Duignan here with me. She's freaking amazing in the private money lending world. So a lot of you guys have reached out to me via Instagram, YouTube, asking like, hey, how do we get into private money lending, right? So I reached out to Sheri, and she was willing to come on here and talk to you guys and talk to you about her experiences and kind of like talk more about fix and flips, double closes that she's done, right? And share her experiences on how she's actually able to make some good money doing this, right? So Sheri, thank you for being here.
Thank you so much for having me. I really appreciate it. Good to see you.
Hey, same here. So I don't want to get into it, right? So I know you do some fix and flips and double closes, right? People that don't know, fix and flip is pretty easy, right? But what is a double close?
Yes, in the private, so double close is basically where in real estate you have people that are called wholesalers. I don't know, a lot of people don't know that they exist, but they actually go out and they will negotiate with sellers who are selling their home, maybe struggling to sell it for various different reasons, and they will negotiate to buy that home for some type of a discount. And they're solving a problem for the seller, but then they're going to go take that same home that they just put under contract to buy, and they are going to buy that house, but they are not going to be the people to actually renovate it. So they go find a fix and flip person, somebody who actually is going to go do all the renovations and then turn around and sell it. Or they could even be somebody that's going to buy that fixer upper and now fix it up and then keep it as a rental and renovate it and hang on to it. But the wholesaler is just literally putting it under contract only to be able to quickly resell it. So what they do in a lot of states, they can't just sell the paper to the person. They have to actually close on the property, buy the property with a title company or a title attorney, and then resell it to the end buyer. So the wholesaler doesn't typically have all the money to be able to buy maybe a $300,000 to $400,000 or $500,000 home and close on it, even though it might just be for a 24-hour period. They don't have those funds. So they'll borrow those funds. So what we do is we will fund in the money for them to be able to buy the property, close on it, and then immediately the same day, usually sometimes it's the next day, sometimes it's 24 hours later, they will close again to the end buyer, who is the person that's actually going to end up owning the property. So a double close is, from a lending standpoint, what I love most about double close is that it is probably the safest. If you do it right, there are certain steps you have to take, but if you do it right, is one of the safest ways to make money as a private lender. It's what they call kind of transactional lending. So it's literally just for that transaction. So you're getting a quick payout. The con of investing in double close is it is kind of more high touch, meaning your money, you have to do all the paperwork, do all your due diligence, work with the title company, get everything in place. You fund in the deal that day. The next day, let's just say you're getting your money wired back to you. Now you got to release any kind of liens and things like that. And then you got to go find another deal, right? The deal is only good for a day, and now you got to keep doing it. So it's not as passive as some people want for private lending. But double close is simply you're closing two deals back to back. One is with our funds as the private lender, and the other is with other funds, for the end buyer.
Gotcha. Man, that's pretty cool. So I haven't done a double close. I've been fortunate to be able to use my own money, right? So yeah. I am a wholesaler, right? I have wholesaled several properties. So yeah, I definitely see the benefits. So now, as a double close, right? What kind of returns are you looking at on a double close? Let's just say you're, $300,000 property.
Yeah. So if you're doing, in every state, every situation is a little bit different. And that's kind of, again, the beauty of private lending is you make up your terms, so each deal you're going to do it based on what you're looking at. But generally you're looking at charging 2 to maybe 3, sometimes 4% of the loan amount. So so it is a quick in and out transaction, but it's very expensive money. So there's no quote unquote ish typically, but it's strictly just a point or a percentage, so if it's $300,000 home, you charge 1 point, it's going to be $3,000, right? If it's 2 points, now you're talking, $6,000, right? So it's usually, I'd say, kind of average is going to be maybe 3 to 4 points sometimes. that you're making on that loan for 24 hours. Because it's so safe. So a lot of people, what they always are looking for with their money when they're trying to invest in, private lending is, how is my money secured? And in double close, like I said, it's one of the safest because, again, if you do it right and you're in communication with the title company and you're saying, okay, we will wire in the funds. We do all our due diligence that we need to do. We're ready to close. We're going to fund the money to the title company or the title attorney. And we give them explicit instructions that they are not to release those funds to close until they have confirmed and have received the funds for the end buyer in place in their office. So in other words, the other buyer has to have their funds in place at the title company. And then once those have been in place and they're there, then they'll wire our funds or they'll use our funds, to close the transaction. If those funds, if for some reason the end buyer is going to back out, right, and not going to actually close, those funds don't come in, they are never to use our money. Our money could sit in the title company, but we're going to ask them for those funds back, right? So the risk is if you don't do it right, you close on the property and now the end buyer doesn't show up, right? And now there's the benefit of private lending with doing 6 months is you can turn your money multiple times. So you're getting those points and different fees that drive the returns up higher. But for fix and flip, generally what I'm looking for is I will typically work with experienced borrowers. So I'm looking for someone who's already completed a minimum of usually 3 transactions successfully exiting the program. And so as long as they have successfully completed other flips, then we'll look at the deals that they're moving forward with now. And so for fix and flips, we are generally funding in no more than like 70% of what we call the after repair value, right? So when you're buying a fix and flip, you're buying it at a discount, you're going to the borrower should be figuring out obviously what they're going to be able to sell it for and how much they need to renovate it. So what we do is we look at the comps that they're sending to us and then we run our own comps. So we go in, we actually look at all of the comparable sales of anything that's sold. We get a good sense of what that after repair value is. And then total loan amount, we are not going to pay normally any more than about 70% of that after repair value. So we want to have a cushion in case something goes wrong. And so then with the borrower, it's a short-term loan. We will fund in some of the purchase price. And again, there's a loan to cost. So that means, the cost of what they're actually paying for the property, renovations and everything combined. We only will lend a certain percentage of that as well, just to, again, make sure our money is safe. So we figure out the loan to cost that we're willing to fund in, and we fund those, to purchase the properties. For fix and flip, it's pretty straightforward, but they're generally a 6-month loans that gives them time to do all the renovations, put it on the market, get it sold, and then pay back the loan at that time. And we structure our loans in 2 different ways. We typically will do monthly payments. So the borrower borrows and pays interest only on a monthly basis for 6 months with a balloon payment at the end of the 6 months for the principal to be paid. But we will also do balloon payments with no payments. So sometimes people have their money in an IRA or use IRA funds and we don't need the monthly payments. And it's more of a pain to have to worry about whether or not it came in every single month. So sometimes we'll do a balloon payment where the borrower doesn't have to pay any payments until the project is sold at the end.
Gotcha. So question about that, because I've gotten several mixed reviews on to take monthly payments and to not take monthly payments. I want to say this conversation, right? I want to touch on it because I've been doing it now for some time, and luckily I've been lucky. And you're running into people like you teach me so much, right? I never thought about it. I'm like, well, man, I never thought about that.
Yeah.
Basically, getting monthly payments is, speaking with you, my opinion, better because you're seeing that, okay, that they're keeping up with the monthly payments. And if something does happen that they don't pay you, you already know, okay,
first indication something's going wrong.
First indication, right? So I was like, oh man, I didn't even think of. Luckily, I've been getting monthly payments now on my loans, right? But I'm like, I didn't even think about it, right? So when would you not take monthly payments? Because
that's a great point. And I, to be honest, when I first started out lending, I did a lot of loans because I came from initially being a borrower. That's kind of how I got in. I was paying money to private, lenders on my deals when I was fix and flipping. and realized how much money I was paying them and thought I was on the wrong side of the, equation then. So when I transitioned over, I had been used to working with lenders who did not charge monthly payments and did balloons. So initially I started setting up my loans that way, but quickly I have learned that it is much better to definitely take the payments. So like you said, it's the first indication that something's going wrong. You're also working with people who, if they're willing to make monthly payments, you know that they have some reserves in the bank. You know that they have working capital that they're expecting to have to kind of make payments. So you're usually working with someone who's a little more experienced. So there's just a lot of benefits to that for sure. I will make exceptions and do where we do a balloon payment. And that really depends on, sometimes it's if I have multiple loans with the same borrower and I'm working with someone who's, again, using an IRA, and it sometimes costs more for the investor, whoever's putting in the funds. If you're using an IRA, sometimes there's wire fees or fees associated every time you take a deposit in or make a deposit, or take a withdrawal. So it ends up costing. Now, granted, that gets passed along to the borrower, but it's one, just more of a headache to deal with for the, investor who's got funds are coming in and out. And two, to have to add up, make sure they're always getting those returned. And two, it's more money for the borrower. So sometimes in those cases, we will waive the monthly fees and just say, hey, let's just do a balloon payment. Sometimes the borrower, or the investor rather, on the IRA side, would rather just get a huge lump sum and then quickly turn that whole lump sum all around, and they're not possibly going to put that much smaller amount of money into something else. So it's sort of a self-made saving. So sometimes just the people I'm working with prefer that method. So what we have to just do in that case is we put other stops in place to still ensure that the borrower is moving the project along, and we don't have any issues that we would have if we weren't taking payments and weren't managing the project, that it goes sideways and we don't know. Right. So we just have to put a little bit more security in place of getting still updates of progress as things are moving along, video walkthroughs, checking in with getting lien waivers. We can still ask for all those same things. That gives us still a lot of protection to make sure that, everything's going okay.
Yeah, perfect. All right. So people that come to you, right, to say, hey, listen, I'm got a property, I'm looking to borrow some money from you. Right? What is your vetting process? What does your vetting process look?
That's a great question, because I think a lot of people get frustrated because I ask for a lot. But you got to understand, especially as a first-time borrower with us, if we've not worked together, it's really important that we not only vet the deal, but we're vetting the person, right? Because, we're now in partnership basically with these people, and it could be a long-term relationship. So what we typically do is we require, we will look at a background check. So we want to make sure that there's no criminal history or, past craziness going on. So we want to see that they're an ethical person, hopefully, and things are going right. We will do, so most of the time, like I said, we are looking at people who have done at least 3 flips, right? So we asked for their past HUD statements, the settlement statements from when they closed on the sale of the property. So we want to make sure, one, that they made money. So we're looking to see, that they actually made money. We are also looking to see who was the lender, and then we ask for references for their prior lenders. So most of the people who we're dealing with have, obviously, if they've already done 3 deals, have also worked with potentially 1, 2, or 3 different borrowers, right, or lenders. So we will cross-reference the lender on the HUD to the lender that they give us as a reference and make sure they're the same. Okay, if they're not, then we're going to ask for, can we get the contact information for this particular lender? And so we will actually call and check references. I actually just we have a new borrower that we just vetted that we're doing a deal with. And I actually got 7 or 8 references of past lenders from this person. I called every single one. Actually, I think 6 out of the 8 actually did call me back. And they all gave stellar reviews, said they would definitely lend to him again. They just didn't happen to have capital available. As a private lender, sometimes your money might be all out when somebody's coming to you, right? So we look at their references. We ask for a statement of real estate owned. We want to see how many properties they currently own. We want to know the status. Are they other fix and flips, or are they, rental properties? What is the status? What kind of assets do they have? Because should something go wrong on this particular property, we want to make sure that they have some assets that possibly they could have, they might have to sell them. We want to make sure they have some reserves in the bank. We want to make sure that they have money to be able to get through this, if they go over budget, they can pay for that stuff. And so that's why I like people that are willing to make monthly payments, because they have money in the bank, right? So they generally have some reserves. So our vetting process starts with, the borrower, their background, just again, making sure there's no, we want to make sure they don't have foreclosures on their books. Then we want to check references of prior lenders. That's probably the biggest one. We want to check HUDs to make sure that the projects that they have done, like you said, if there are contractors we can reach out to, we want to make sure that they've paid their contractors, because the other thing that can cause a project to go sideways is if you're paying them maybe the rehab money, you're giving them draws, but they're not paying their contractors. They might be using that to continue to do other things on the project and not actually paying their people. And next thing you know, you get a mechanics lien on the property and you can't close without satisfying, right? So we do check with contractors to get references. We do ask them if they're using the same contractors, because as we all know, sometimes you can get bad contractors. And if you haven't used them before, that's a red flag, if it's a new contractor, and we want to make sure they have backup people, again, if that contractor walks off the job.
So we were just saying earlier before we started, deal that you, right? Yeah. Can we talk about that?
The one that's going wrong?
Yes. I think it's important to know, okay, how are you protected?
Yeah, and as I say, so we'll start with kind of that. I think the biggest question I always get, because I work with not only my own capital, so I use all my own funds, but as I'm now scaling, I'm bringing on board other people who, they might be doctors, lawyers, there's some of them are just trades guys, that have capital that they're making good money out there in the trades, but they want to invest it. And they don't maybe have access to the deals and all the paperwork and all those kinds of things. So I bring them on board and I'm helping to vet the deals, vet the borrowers, those kinds of things. So in order to, the first question they always ask is, how am I going to, make sure that I'm getting my money, and how am I protected if something goes wrong? So of course, obviously there's vetting the borrower, then there's vetting the deal. And then the biggest part is the paperwork. So the biggest thing is your promissory note. You want to dot every I, cross every T, have an attorney look at it, make sure it's not going against any kind of usury laws and, become an issue down the road. So the promissory note is very, very important because it spells out exactly how much you're lending, when you're going to be funding in the different amounts, what are the different, sort of contingencies on getting draw funds for rehab. It talks about what kind of payments and how much they're paid. And I put the exact dates. It's due on March 1st, April 1st, May 1st, and the exact amount. So there's never a question of how much that payment's going to be and when it's due, right? And then if it's late, all those terms are spelled out in the note. Where people go wrong and where I see people mess up is they think that the promissory note is what secures the money. Promissory note does not secure the money in any way. The promissory note is literally just an agreement between, you and me, right? You as the borrower and me as the lender as to what the terms are. But that needs to be secured then by a deed of trust or a mortgage, depending on the state. They're the same thing. It's just they're called different things basically in different states. So if you're in Florida, you're going to do a mortgage and that needs to be recorded. Okay. So what we do is we do a promissory note first, then we go through a title company. We never, I'll say, and if anybody asks you to, don't do it, but we never wire directly to a borrower. So we are always going through a title, a real estate attorney or a title company. They are the ones that receive the money and then disperse it to the borrower. So we communicate directly with the title company and attorney. We do not rely on the borrower to have that communication. So we're very clear that we need this promissory note signed and we need a wet signature returned to us overnight after it's been signed at the title company. So they have to overnight it back. Again, those fees are paid for by the borrower. Then I want to make sure that it's a recorded deed. I did one time rely on a borrower to communicate with the title company early on, and they did a deed of trust. It was signed. I got a copy of it, but it was never recorded. So that needs to be very clear that it needs to be recorded with the county, because if it's not recorded, they sold the house and didn't even pay off the note. Because there's nothing clouding the title or lien. So you want to be very clear that it needs to be recorded. And then again, that wet signature copy, the official copy, also gets returned back to the lender, and they hold on to that. We are named as additionally insured as the first loss payee on any kind of hazard insurance, or if there's earthquake insurance or flood insurance, any of those types of policies, we need to be named. Even if there's an HOA and they have a policy covering, if it's like a condo, we get named as additionally insured mortgagee on that policy. And you want to make sure that it's at a coverage amount that covers our loan. And then some. And then we get a personal guarantee from all parties in the LLC. And this is another area where I see people sometimes mess up is we're lending to an LLC. We're always lending to a company, but they will get the signature of one officer within that company, the signer who's able to sell property. They get one signature, one personal guarantee. So you want to get an operating agreement, and you want to find out all members of the LLC, and you want to get a personal guarantee from every single member that's in that LLC. Because if they dismantle that LLC or that LLC gives belly up, you now can go after any of the officers. And if they disperse, you're covered by everybody, right? If somebody leaves that LLC, you're in good shape. So the personal guarantee, but I will tell you another mistake people make is they get a personal guarantee, but they don't know that the person has assets. So personal guarantee means nothing if the person has nothing to guarantee it with, right? If they have no assets and they're upside down and highly leveraged, you're not going to be able to go after anything. So you do want to get like a statement of real estate owned and a statement of assets. So you want to get an accounting of what kind of assets they have available so that you just know that they do have something to go after should you need to. And the goal with me, you don't need to.
Yeah, gotcha. So the deal that you're having.
So my deal, let's say, so the one I just told you is the deed never got recorded, and they did actually. It was coming time for the balloon note to be paid, and I happened to pull up the property and noticed it had been sold, and I was like, wait, what? And we got it resolved, and they did pay us. It was sort of an oversight overall. It was not a thing, but could have. But the deal, so I do have a deal that I did. This loan was done about 2 years ago, and it was one that I did early on where I was didn't take payments. It was a balloon payment at the end, and we didn't have any rehab funds tied to it. It wasn't tied to a rehab, so we weren't necessarily getting the regular updates we normally get if we're doing the rehab loan. And so there's a whole long story to it. I'll give you the backstory is this person had multiple flips going on, one of which ran into a title issue, and they had renovated this property, getting ready to put it on the market. And I think actually it had been put on the market, and then someone saw it listed on the market and came out of the woodworks and said, I don't know how you bought this property. I had an interest in this property. I never signed off on you purchasing it. I own this property. And it went to court, and unfortunately the rehabber lost that situation. Now, I don't know for sure if they had title insurance, because I feel like the title insurance should have covered that, and that's another thing that we always make sure is that we have a lender's title policy, and that the borrower has title policy on that property, right? But this was a different property, not tied to mine. So mine was okay, but he had put about $300,000 total between purchasing the property, the renovations, all that was tied up into this house, and he lost the house. It was not, they said, no, you're right. This guy didn't approve to have this, sold. And so that spiraled all the other renovations he was doing because he couldn't pay those funds, right? And he couldn't get that money back that was tied up into that property. So what ended up happening was it sat for a long period of time. I did hire an inspector to go and just see what what level had been done. So we kind of knew where we were sitting. He finally got some funds to be able to get the project, going. It actually just closed in December. So we stopped the bleeding as far as, he's out of the dark of it. But he had gotten behind on taxes. He got behind on, he actually had a couple code enforcements because the grass got so tall. So there were some other liens that got put on the property. And I think to keep things going, he had actually put another lien behind mine. So he had another lender that was somehow willing to loan, after the fact on that same property. So when it came time to close, he was going to have to owe about $50,000 to clear all the liens. And he didn't have the funds. So as all the borrowers listed, all the people with the liens, we worked together to try to figure out how we can all get something, a piece of the pie. So we negotiated, we all came down on what was to be repaid at closing so that it could close. So I came down, I think I ended up at about 40% of my capital, my initial capital, I got back at closing. And then no interest. And then the remaining was rewritten onto now what would be an unsecured note. So the note was no longer secured by the property because it got separated, right? Because it was closed. So I got paid out at closing. Like I said, a big piece of my capital. So at least I got something. Yeah. And now he's on a monthly payment, and he is working hard to wholesale and find other properties to get chunks of money to end up repaying me. So we have another 6-month note that's out there at the higher interest because it's no longer secured by a property. And he didn't have another one I could secure it against that made sense. And he's made payments. So we're in second month of monthly payments that have been being paid. And they're just small interest only still, but the idea is that the principal will be repaid as he gets these chunks. And there's a balloon payment again at the end of the 6 months. So, and that's the thing as a lender, and again, as a private lender, we had every right to try to foreclose and take the property and different things. And I could have even stepped in and tried to renovate it, myself and try to get the money back, that kind of thing. But, trying to work with the borrowers don't want to ruin their relationship with their money partners. And because this is what they do and they want to continue, they kind of want to continue, or they don't know when they might want to go back. They don't want to ruin that reputation and they don't want to have a bad, name. And they, if you're working with people that are, like and trust, they're going to do things to make the lender right. So I didn't want the house. I didn't want to have to go to, it's up in Michigan or whatever. I didn't want to go up there. It's too cold. So we've negotiated terms and like I said, it's being repaid and, we're in good communication.
It sounds to me like you've dealt with him before. He's done projects and he pays his debt. So it sounds to me like he doesn't want to mess that relationship with you. Right, because this sounds like this is what he does full time.
It is. And that's the thing. And there were some red flags that I probably could have picked up on, again, now knowing more, and having gone through the experience. There's a laundry list of lessons I've learned, but, couple red flags is, again, even though somebody is a volume borrower, it's nice because you're constantly doing more and more loans with them. But if they get if they're doing too much volume from what they can handle and they start maybe making mistakes, that's when things can go wrong too, right? So volume is good because it's usually someone that's experienced, but at the same time, volume can all come crashing down and crumbling down if you're not doing it right. So just, monitoring how many projects they have going. And that's another thing that when we're vetting a borrower, we want to know how many. That's why the statement of real estate owned and what they've got under that LLC currently in their possession helps us understand what their capacity is and making sure that they don't overextend it, and doing bad deals just to do deals sometimes, right?
Yeah, no, I mean, great point, man. That's awesome. So, I mean, it sounds like this gentleman is a good person, right? Because he's just like, hey, all right, it happened. Shit happens. Not every deal is going to be great.
Correct.
So, but
stuff does happen, and I mean, and it's real life out there, and there's things, people's renovation projects get broken into, and they steal the HVACs, and that blows up the budget sometimes and things. So, there's things that can happen, and we just have to, as long as you're in communication with the borrower and you're constantly talking through things, you can work through, challenges that come up. And there's lots of different ways. I mean, we can get to this a little bit more, but there's lots of different ways to, again, protect yourself and yet also avoid a foreclosure and losing money. I mean, and even with the foreclosure, you might not lose money. You might actually make more money than you expect. So, and that, like I said, not all deals go great. Some go sideways like that. I will say on my track record, that's really the only one that's ever gone, crazy sideways, knock on wood. But then there's some that go even better than expected. And I was telling you a little bit about this deal too. Just recently brought on a new investment partner. It was her first loan working with me. And so we were sort of 50-50 partners in this deal. So they brought in 50% of the money, I brought in 50% of the money. And that's usually how I try to do my loans. And so we were doing a really heavy lift to the point where she was a little nervous. She's like, "Are you sure these guys can actually do this level of rehab?" I said, "Yes, I've done dozens of loans with these guys, and a lot of them look like this." So the purchase price on the property was $40,000. And the renovations, the total loan was $165,000, right? So the renovation was just a huge renovation. So we want to make sure we're not over leveraged, right? So the value of the property, I think at the time as is, was around 65, 70,000 or so. Might have been a little bit more than that. So we funded for closing. I funded in 20,000. She funded in 20,000 for the $40,000 close. And then we set up draws. And so they had to complete $30,000 worth of work, send us video walkthroughs from the street with the address. So we make sure it's the right house, pictures of the renovations, invoices, and lien waivers to make sure that the contractors have been paid. And then they're not putting liens on the property. And so 3 months into the project, we hadn't gotten any requests for the draws yet. And we've been monitoring the progress. They had a lot of clean out to do. And they came to me, and we were doing a bunch of payoffs from other loans, these guys I do a lot of business with. And they said, we need a payoff for this property, right? And I thought, what? And so I went back to him. I said, well, we're closing on this property on the 7th. I said, I think you sent the wrong address. And he goes, no, we're getting rid of that one too. You haven't started it, other than cleaning it out. Well, they ended up wholetailing it, they call it, right? So they cleaned it all out, cleaned it up, got rid of some of the really scary stuff. And they ended up finding another fix and flipper that was willing to pay them, to take over that project and renovate it for a profit, right? So they came back to us, and we did a payoff. And like a week and a half later, they closed and paid off the loan. It was supposed to be a 6-month loan. So in some ways you go, well, we didn't make the return. However, the way this loan was structured, they paid points based on the full $165,000 loan. They paid interest based on the full $160,000, $65,000 loan. And then, the fees and stuff involved in it. For the $20,000 that we had into it, we made pretty decent interest and points and all that kind of stuff. So the return in 3 months was pretty good. So you have those kinds of deals that come up every now and then too.
Yeah. So that makes up for the others and stuff. And it's just, I've heard horror stories, but then, you hear these stories like stuff like, okay, wow, you're actually, okay, you lost, but you actually found a person, right, who's willing to take, like, okay, you know what? It didn't come out well. I'm going to take responsibility for it. I'm going to get you your money no matter what.
And that's where checking references and knowing that person, and a lot of the stuff I do now, most of my deals come from, I'm in a lot of networking groups and masterminds and things. So I work with people that I kind of know, and we have a relationship, and generally people don't want to burn those relationships, right? And especially because I also then talk to other people within the groups and stuff. So I've been, I'll say very blessed. God's watching over me somehow or something, because, we've been very fortunate that, even when, in a couple of the projects, every now and then they might need to skip a payment because of cash flow for some reason or something, but that rarely happens. And I think a lot of it comes from really spending time to vet the borrower. And I'll tell you, most borrowers that come to me looking for a loan, typically they need that money within the next 2 weeks. And a lot of times I'll tell them, look, I'm not going to probably be able to fund this particular loan, but I would like to vet you as a borrower and get you on our borrower list as a preferred borrower, and hopefully we can do future loans in the future. But if you're looking for me to try to vet you and do this deal, it's probably not going to happen in a week or two, right? And a lot of lenders just want a deal, or they see the numbers and the return, and they're like excited because it's a big return, or it's a good number. But if you don't do your due diligence, a big number could turn into an upside down number, right?
Like, I definitely want to, glad you mentioned that, because I started doing this, last year, and luckily I run into a great mentor, right, doing that, and he was able to show me these things, it's kind of like what you're saying, like, you don't just want to, go in and let, you want to take your time, do your due diligence, like I'm doing one right now.
And sidestep processes.
I'm like, hey, listen, it's probably going to take about a month, to make sure that I bet you, as long as you give me everything that I need, because I am making phone calls to your GCs that you've done work with. I am making the phone calls to your private money lenders. I am checking your background. Like, if you don't want to give me those things, then I already know that there's something up.
Yes.
So I'm just going to do it.
Yeah, and that's the thing. So like I tell people, like, take your time. Don't get so excited that you just, like, especially people that are new, like lending for the first couple times, like they see a deal, they see a good return, and they just want to do the deal. And I'm like, no, just take your time. Deals will come. There's always a deal.
You're like, hold on, you're kind of rushing. That we need to do this. Like, so what's going on? So to me,
it's like Valentine's Day's tomorrow, right, or whatever. It's like courting. It's like dating. You don't just, you don't go from meeting to marriage, right? You gotta date. You gotta get to know each other, right?
Well, Sheri, I think this was amazing. Thank you for your time. I definitely think we covered a lot. A lot of questions that I know that I got from people asking me, like, how do you do this? How do you do that? So I definitely think there's much more clarity.
Yes.
How do people get a hold of you? Right, in case if they do have some money and like, hey, listen, I have this $100,000 I want to go ahead and invest, right? Sheri, Ricardo seem like good people, right, to invest with. Like, how do they get a hold?
Yeah. So they can either, probably the easiest way is go to my website. I've got two different sites. So one is wholesalerfundingsolutions.com. So that's pretty easy, wholesalerfundingsolutions.com. And then we have opportunityenterprisesllc.com. And if they want to go there, there is, I do have a private lending simplified book that goes over exactly, some of the things to look out for, how to vet the borrower, how to vet the deal, and, how to set your rates and your terms and things like that. But they could get a free copy of that book downloaded on Opportunity Enterprises LLC. So that's probably the best way.
Perfect. Beautiful. I'm actually going to post all those things, on the bottom of the YouTube. Right. So I'll go ahead and make sure I put those there. Also, you guys can reach me at my YouTube channel or Ricardo Obregon01 and on Instagram. All right. Bye, Sheri. Thank you so much.
Thank you. Take care.
Bye.
Bye.